Investing in puts involves buying options, contracts that gives you the right to sell an underlying asset. So, such as stocks at a predetermined price before a specific expiration date. So this strategy is typically used when you expect the price of an asset to decline. To begin, it's essential to understand how options work. A put option increases in value as the price of the underlying asset falls, allowing you to profit from a decline in price. To invest in puts, start by selecting a brokerage account that offers options trading. You're going to need to meet certain eligibility requirements and understand the risks involved, as options can be more complex than traditional stock investments. When choosing a put option, you're going to need to decide on the strike price, which is the price at which you can sell the underlying asset, and the expiration date, which is the time frame within you can exercise the option. Once you've selected a put option, you'll pay a premium to purchase the contract. If the price of the underlying asset declines below the strike price, you can either sell the put option for a profit or exercise it to sell the asset at the agreed upon price. However, if the price rises or remains stable, the value of the put will decrease, potentially leading to a loss of the premium paid. Let me know if this helped.